Elon just tweeted about Powell being wrong about rates not getting cut in the next couple of years. That's not what he said. Oh, that's not what he said. So there's been a lot of debate about Jerome Powell making this argument that the Fed is not going to cut rates for the next 2 years. This is another mainstream media argument that, oh, Powell says he's not going to cut rates for 2 years. Problem is, if you look in context of the question that he received, Jerome Powell was asked about 2 year projections. So he was answering about 2 year projections. He was not saying rates are not going to get cut for 2 years. That's not what he was saying. If you look at what he said out of context, that may seem like that's what he says. But what he actually did is he referred to his formula again. He referred to his formula, which his formula is take inflation expectations, add some level of restrictiveness, and that's what nominal rates should be. So if inflation expectations, as he told us last month, are 3%, and you want rates to be 2% in terms of, or you want real rates to be 2%, well, then that means you need nominal rates to be 5%. Well, that's where we are now. 5% minus inflation expectations 1 year out of about 3%, 1 to 3 years out, then you get to a restrictive real rate of 2%. And Jerome Powell, in this response to, oh, they're not going to cut rates for 2 years, in his response, he's talking specifically about 2 year projections. And he actually made it clear in his response that, well, look, as inflation falls, you're going to have to adjust rates down to keep rates at a restrictive level that's equal to what it has been. Because if you don't reduce rates, you're actually increasing rates by not reducing rates. That's what he said. However, a lot of people were very, very confused by Jerome Powell's response because he was responding to a question specifically about this, uh, um, 2 year projection. And I think that really skewed people's understanding of what he meant with no cut for 2 years. So yeah, I want to add some good clarity about that. Jerome Powell did not say they would not cut for 2 years. He did say they would not cut this year, but that's okay. The bond market's already priced that in. But this no cuts for 2 years, it literally defies the very definition he gave in the response and the very definition he gave last month. So no, that's a fundamental, out of context misunderstanding of what Jerome Powell suggests. Let's take a look at what Nick T has to say in the Wall Street Journal this morning. He got a little schooled by Jay Powell yesterday, or at least that's how social media picked it up when Nick T was asking about the pace versus the level of hikes, and Jerome Powell made it clear that there's a big difference versus pace, and the reason they pause is because now they can focus on staying at a level for a very long time. So we'll go through what Nick T here together says. However, it's worth noting a few things as we go into Nick T's piece. First of all, Bloomberg is running headlines that the Fed is indicating at least 2 more rate hikes, or that Powell is. I don't think Powell was doing that at all, but the summary of economic projections was. Obviously, the summary of economic projections coming in hot at 5.6, though worth noting, very good point, that the summary of economic projections came out on Friday, or was submitted by members on Friday, which is before both CPI and PPI data. Despite this, though, markets are red with a 71% chance of a hike on July 26th. And by September 20th, we're looking at a cumulative about a 77% chance of at least one hike, if not two. So let's take a listen here to what Nick T says. Also keep in mind that Richard Clarida this morning did indicate that maybe only one more rate hike would be expected, and that 2 would be a bit aggressive. And so we'll see. There's a lot of talk that the Fed is actually closer to being done than where they where people might think that they need to go, and that would imply maybe one more rate hike. But let's see Nick T's piece here. So Fed officials agreed to hold rates steady after 10 consecutive hikes. The new summary of economic projections after their 2-day meeting suggested they were leaning towards slowing down their increases versus stopping them altogether. Most of them penciled in 2 more rate increases this year, which would lift them to a 22-year high. They really needed to hammer home the message that this was not the end, which they did. And this was something that we had all suspected, that is the Fed really actually thinking about raising rates 2 more times? or are they just trying to indicate some messaging to the market that, hey man, don't think this is a pause. Let's go a little strong then and indicate or prove to markets that this isn't a pause. And let's send them a signal, even if we don't believe it, that this is just a temporary skip. We even had Jerome Powell slip up and mention the word skip once and then retreat and say, oh, well, I shouldn't call it a skip. Oh, so have you been talking about it being a skip? Anyway, its post-meeting statement, the Fed implied the decision to maintain benchmark Fed funds rate would be at the level where it is now would be short-lived. After holding the Fed funds rate near zero following the pandemic, the Fed has raised. Okay, we know the history of it. Now we want to get some more future leaks here, NickiLeaks. We don't need a history lesson here. Wednesday's decision not to raise rates is a continuation of that process, said Jay Powell. Common sense to go a little bit slower, yes. Officials had signaled growing disagreement in recent weeks over whether to keep raising rates. Some officials became more doubtful in March because of the banking crisis, but it's too early to see signs of the banking crisis. That's true. Jerome Powell gave a lot of I don't know answers yesterday. A lot of I don't know if we're at restrictive level of rates. I don't know if inflation's coming down. I don't know if the banking crisis has taken a hold yet. A lot of I don't knowing yesterday. Again, leading some people to believe that Jerome Powell's aggression potentially yesterday was maybe somewhat disingenuous and actually misplaced. Powell and some colleagues had hinted at a potential compromise last month in which officials would forego a rate rise in June while leaving open the prospect of an increase in July. A potential compromise hinted at last month. Interesting. But recent economic data and hiring on inflation have been stronger than many forecasters anticipated. This is true for hiring. I wouldn't argue this was true for inflation. Inflation seems to have come in softer in the latest reports. It's not clear what the criteria is they're looking for. Projections showed that 12 of the 18 officials think they will need to raise rates up to potentially 5.5%. Yeah, that's true. Actually, it was 16 of them, rather, projected an increase to 5.25 to 5.5, and 12 projected 5.5 to 5.75. Gives you a little bit more of a breakdown on the piece here. Another four officials projected they would need to go up by only a quarter point. Exactly. Okay, there's the fill-in. Powell has kept his committee united since inflation surged 2 years ago. It's true. Every vote so far has been unanimous. So that's the way somehow Jerome Powell is, as they say, corralling everyone. It will be harder next time for them to raise rates than they realize, says Richard Reinhardt, a former senior Fed economist who is now an economist at the Dreyfus Mellon. This is actually something that Jeffrey Gundlach, billionaire investor, also indicates. And he's bear. He's very bearish right now. He actually thinks people should be long bonds right now. Yeah, he's anti the stock market broadly, from just based on some of his commentary. But his latest commentary yesterday suggests that the Fed is done, that a pause is in, and that you shouldn't be confused that this is a pause and the Fed trying to signal hawkishness while in reality indicating they're done. Yesterday, I did run a Twitter poll with about 3,250 votes. 51.2% of y'all indicated the Fed was done. However, the other 48.8% of you indicated the Fed had either a 25 or 50 basis point hike left in them, with that vote about split on how much. The data probably will be a little bit more ambiguous. Their headline explanation is that they will know much more in 6 weeks, but the fact is they won't know much more in 6 weeks. Chances are they'll be more confused in 6 weeks. Well, that's why I think they'll probably end up pausing through to September. The economy has shown only modest signs of cooling in recent months. The share of workers voluntarily leaving jobs has returned closer to pre-pandemic levels, suggesting that the tight labor market has eased a bit. But steady hiring and wage gains could sustain elevated inflation. Although, in fairness, the Fed did just throw, and Powell did briefly comment on it, they did throw cold water on the idea that wage gains are certainly linked to higher inflation. This is thanks to a Federal Reserve piece out of the Bank of San Francisco, where the Fed's indicated that, hey, maybe there isn't as strong of a link between inflation and wages as we had previously thought. It doesn't look like Nick T is choosing to talk about that at all. Housing market, one of the sectors hardest hit by last year's rate increases, has seen some improvement. illustrating how difficult it has been for the Fed to slow the economy and balance supply and demand. True, because there's just no housing supply. So what do we take away from this? Well, I think what we take away from this is, well, that of course tomorrow there's an expiration of those programs on building your wealth. All of those. I mean, look at all the different programs we have, and they're phenomenal. You've got the income side and the investing side. A lot of people didn't realize, by the way, we had the property management and rental renovations course. That's a very good one. We've got someone with over 35 years of property management experience joins me in that one. Really exciting. Real estate investing, stocks, obviously, but all of these programs and the income course is getting a price increase tomorrow at 11:59 p.m. That's the 16th, and that'll be part of the phase 1 of 4 phases of increases. And that's as we're coming out with a large new lecture set at the end of these 4 phases. But I guess my bottom line takeaway of this is, look, we expected the Fed would have to talk dirty to us if they paused. There was no way they were going to be able to pause and talk nice to us, because that would just sustain a market rally. And that's kind of not exactly conducive of encouraging inflation down. We talked about that. We talked about the wealth effects beforehand. We somewhat saw that. I don't think anybody was expecting the Fed to be this hawkish. We were expecting a hawkish pause, but not this hawkish. However, when we evaluate that, well, but wait a minute, the summary of economic projections was actually submitted before this week's data. It kind of makes you scratch your head and go, what's the point of the summary of economic projections if you don't put it together when you have all the data? It's a little frustrating, and maybe that's why Jay Powell was actually frustrated yesterday. Maybe, just maybe, he was frustrated because he realized this data came in softer than expected, yet he had to present this summary of economic projections that was more frustrating, perhaps, and unrelated to the latest data that we've actually received. So we'll see. But that's the latest that we have from the Fed. And now we're going to move on over to looking at the European Central Bank and their rate increase. Oh, I suppose I could quickly also note this. We talked about this a little bit earlier in the stream. I figure I just show this quickly as well. One last thing is this world interest rate probability chart right here is still indicating a bias towards potentially a pause, keeping at a pause in July. This 5.25 level not being quite high enough to really indicate that push through, but that push through does get priced in for another rate hike in the September and November meetings. And as expected, many economists now punting their recession expectations. That's something else we've been talking about for a few weeks now, where we've said that, hey, look, it's highly likely economists are going to realize, oh crap, Q3 is only 2 weeks away. I guess the recession won't come in Q3. And sure enough, that's exactly what we've been getting from economists and new analysts. Here's, for example, a piece here. U.S. economics. We have revised our outlook for a delayed downturn and higher policy rates and push out our anticipated slowdown in the U.S. economy by 2 quarters. Now out to basically the end of the year rather than Q3 and potentially Q1. So Morgan Stanley, let's see what they have to say. So a slight adjustment in the statement should not be ignored. As expected, the Fed held the range of the Fed funds rate steady, but we think this slight change in wording from in determining the extent to which additional firming may be appropriate to in determining the extent to which additional firming may be appropriate. What's the difference there? In determining the extent to which to which additional policy firming may be appropriate, of which additional firming may be appropriate. Wow. Is the consensus of the committee keeping further policy moves in question despite a hawkish SEP? Oh, this is interesting. Of additional policy firming. To which additional firming? I'm personally, I have a hard time breaking apart this one. I think what they're trying to say is they're, while maintaining a tightening bias in the statement, is a consensus keeping further policy moves in question despite more hawkish. I'm not exactly sure how to read this. As expected, the Fed held the range of the Fed funds rate steady while maintaining a tightening bias in the statement. But we think a slight change in wording from those statements is the consensus on the committee, keeping further moves in question despite a more hawkish SEP. So what they're saying is they're trying to say, hey, the statement and the SEP were hawkish, so we'll put a little H there, but that actual little change was dovish, potentially putting in question. This just shows you that they have no freaking idea. That's really the answer there. In the S&P, we saw a move up to 5.6 from 5.3. We vividly recall that upward revision to inflation projections, despite data coming in line with the Fed's March, was most perplexing. Right, I would agree with that. Moreover, the upward revision in the S&P was paired with inflation risks that are still weighted to the upside. Yeah, he said that like 30 times. In relation to our forecast, we think this sets up core inflation to fall faster than the Fed currently projects, which should offset the takeaways from a higher peak rate in the dot plot. By the September meeting, we believe core inflation projections for this year, as well as the level of the Fed funds rate, what? Just going to cut off like that? Oh, could get revised downward. Interesting. And that's actually interesting. This is not the Mike Wilson Morgan Stanley camp. This is your other camp inside Morgan Stanley. And this is actually somewhat of a bullish and dovish statement, if anything. Powell attempted to strike a balance between the FOMC statement and showed a more flexible data-dependent consensus. Nearly all committee participants expect that it will be appropriate to raise rates somewhat further by the end of the year, and the July FOMC meeting will be live. He also underscored the dot plot shows no cuts expected until 2024. I think, as anyone can see, not a single person on the committee wrote down a rate cut, nor do I think it's at all appropriate. At the same time, there were more dovish comments emphasizing that these SCP projections are not a committee decision or plan. The committee made this decision today only about this meeting. We did not make a decision going forward. It's true, some more distancing there. Pause sets a higher bar for a follow-up hike. There's only one more jobs and CPI data print between June and July. Not enough data to paint a different picture of the economy. We preliminarily expect June payrolls to be over 200K, but paired with moderation in core CPI. Let's see, falling for a third straight month. Powell emphasized the need to see more data. We think that puts them more on pace for a September hike. See, I agree with that. I would lean towards September as well, just to get enough data. Buying time, basically, right? Yeah. All right. So that's Morgan Stanley's take. In the latest outlook, we continue to see a soft landing for the economy and wages slowly easing, as well as job gains consistent with economic outlook. We expect the Fed to hold the peak rate at 5.1 for an extended period before making the first 25 basis point cut in March of 2024. Okay, then let's take a moment and jump on over to what JPM says, and then we'll have seen Morgan Stanley, Goldman, and JPM. I prepared JPMs for us here. This is the one they're kicking the door in again. Oh, these headlines. All right. Here comes JPM. Here's the JPM report. JPM, the outcome of today's FOMC meeting was hawkish and peculiar. While the committee unanimously voted to leave rates unchanged, a large majority of the FOMC participants anticipated at least 2 more rate hikes this year, and only 2 see the current setting as appropriate. So why not hike today? Powell said it was a continuation of slowing down the hikes. He tried not to tip his hand on July, but given how many on his committee are inclined to hike multiple times this year, it may be hard to get them to pause for more than one meeting. As such, we now look for one more hike in July. We continue to believe the lagged effects of rate hikes will weigh further on growth, and don't believe the median 2 forecast will be needed. So nobody's really agreeing that the 2 forecast is the right way to go. Since the decision to hold rates today was well signaled, the real news was the dots, particularly the dots suggesting the potential for going up to 5.625. Given these projections, a recurring issue in the press conference was pausing when 12 of 18 participants see at least 2 more rate hikes in the last half of the year, and 4 indicating 1 more. One can speculate that a deal was struck between hawks and doves to pause, but strongly signal a future hike. See, I agree with that. In fact, that's what Nick T suggested as well, that there was some kind of deal that we're going to pause in June. And then they purposefully went hot to try to paper signal another hike. That's possible. Normally, the post-meeting statement isn't a detail, but edits to today's statement were minor and reflect policy on hold rather than tightening. trust forecast of disinflation, but rather need to see it happen, right? Not trusting the forecast, right? Powell did mention the forecast was wrong before. Yeah, that's JPM. Okay, so JPM sees July, Morgan Stanley September. Goldman seems to agree as well with July, and really seems like what you got is most people projecting at least one more hike. I personally don't buy it because of the soft data, but I suppose we'll see what happens over the next few days in data, and or a few weeks here, and we'll see what happens next month. But boy, I think a lot of people were looking for clarity from this last meeting. We did not get clarity from this last meeting. We got more confusion.